Welcome to the Introduction to Investments. By the end of this chapter, you'll understand the basics of the different types of asset types, how cash flows among companies and investors, and how valuation works. We'll also explore concepts like market efficiency and portfolio diversification, all of which will be critical as we dive deeper into the investment world. So let's begin with the question, what is an investment? It can mean different things, but in this course, it refers to purchasing an asset with the hope that it will store and potentially grow in value over time. Think about a retirement fund like a 401k. Employees contribute to this fund, often with matching contributions from their employers. The goal is long-term growth, allowing you to withdraw funds later in life, ideally at a lower tax rate. Now, the 401k is not really an investment. It is a tax vehicle that permits companies to take employee money out of their checks before tax and contribute additional funds into that account. The investments are the instruments inside the 401k. For the most part, they will be mutual funds. What to buy, how much to pay, and when to liquidate. The big three questions about investing. So the study investments can be quite involved. It can be out of the reach of some would-be investors. So how can an average person get involved in the investment game? The answer to the top three bullets involve a great deal of research. Most people do not have the time or money to perform the research needed to make good decisions. The fourth bullet point refers to the results when we add more and more investments into the portfolio. There is a difference between theory, how we think things should work, and reality, what happens in real life. The decision process involves the investor analyzing an asset to determine the value of that asset to them. They then compare to the current price. So what is an asset worth? Valuation is the process of determining the current worth of an asset. It equals the present value of its future benefits. We all have slightly different valuations of assets, just like we all have different values on the type of soda we drink. Why do we not all drink the better soda, Coca-Cola? We all have different preferences and experiences that we utilize in our analysis. There are many things that impact valuation. Correlation has an impact on the risk when we are subjected to when we invest in portfolios of assets. We will discuss this in greater detail in later videos. There are other theories, though. Market efficiency. How does information get into prices? How long does it take? How can I make money on the information as I learn about it? And certainly the economy has an impact on the values of everything. Correlation, for instance, think about the stock of Ford and General Motors. They are probably fairly highly correlated, as they would tend to do well at the same time or not do well at the same time. However, what about the stock of Ford and Kellogg's? They're probably not as highly correlated, since they are different assets impacted by the economy in different ways. Let's differentiate between two types of assets, real and financial. Real assets are physical and tangible, things like real estate or equipment. Consider a company like Tesla. Its factories and machinery are used to produce cars are real assets. Financial assets, on the other hand, represent claims on cash flows from entities like corporations or governments. Stocks and bonds are financial assets. For example, Tesla's stock is a financial asset that gives shareholders a claim to part of Tesla's profits. Real assets, again, produce economic output. They can be unique. Financial assets, however, allocate how that output is divided up. They are rarely unique. There are basic decisions that managers and individuals make that impact the value of the firm. They are intertwined. So, how do we get money? What do we do with it? And how do we distribute it? So, whether you're a company or an individual, you are asking basically the same questions, right? How do I get money? When do I need that money? Which projects do I invest in? And how do I ultimately use those profits? Those are the decision points that companies make. And likewise, how much do we invest? What returns do I expect to get when I invest? When do I expect to get those returns? And then how do I manage the taxes associated with this? This is how individuals make decisions. Regardless of whether you're a business or an individual, it's always about expectations of the future. There is always uncertainty. Regardless of what happens today, when you make decisions today, you're making decisions about the future. Times change. Tax policies change. Information changes. All of these things impact cash flows in the future. So let's think a little bit about valuation, right? To analyze an asset, there are certain variables we need to predict or analyze. What cash flows do I think I will receive in the future, and when do I think I will get them? So valuation is at the core of investing. It helps us determine the worth of an asset based on expected future benefits, often in the form of cash flows. When Apple releases a new product, investors assess whether this will increase future cash flows, which can then affect stock price. A share's value depends on the anticipated future cash flows from dividends and the growth in the stock's value. Risk is the thing we ultimately get paid for when we invest. As things get riskier, I want to get paid more. So the risk of an investment reflects the unknown timing and amount of the cash flows that we've been talking about. Risk averse is the degree to which a particular person desires to avoid risk. Therefore, we only take on risk when we're compensated for that risk with a higher return. So our goal is to recognize risks and find ways to minimize it as best we can. This is the tricky part of investing, mostly because each of us as individuals have different sensitivities to risk. Older citizens are more sensitive to changes in the market than younger, mostly because they have less time to recover from downturns. So investors are going to have different estimates of those cash flows. They also have different sensitivities to those cash flows. This is what makes the world go round. We all see the same information, but we analyze and emphasize things differently. Now, you wouldn't think things would be extremely different, but they could just be different enough that I see opportunity and value and you do not. For a trade to occur, two investors must have diametrically opposed views of the value relative to the current price. It's a good start for investments. I look forward to seeing you in the next video.